Here is a number that should not exist. In 2025, this cannabis company lost about $40 million before taxes. Then it got a $28 million tax bill. A normal business that loses money pays no income tax. This one paid roughly $42 million in cash taxes in a year it never earned a profit. The company is Vireo Growth. It trades over the counter under the symbol VREOF, and almost nobody covers it. Here is why somebody should. First, the growth, because it is real and it is violent. Revenue went from $75 million in 2022 to $88 million to $99 million in 2024. A solid regional grower. Then it exploded to $269 million in 2025, up 170%. And the first quarter of 2026 alone did $106 million, up from $25 million a year earlier. That is not organic growth. That is a buying spree. Now, the catch. In 2025, Vireo carried $127 million of gross profit down to roughly break even at the operating line, then a $40 million pre-tax loss after heavy interest. A normal company stops there with no tax to pay. Vireo instead booked $28 million of income tax expense, which is what produced its $68 million net loss and an effective tax rate of negative 71%. That is Section 280E. So what is Section 280E? It is a piece of the tax code that bars any business trafficking a schedule. One drug from deducting normal expenses. Only cost of goods is deductible. So Vireo gets taxed on gross profit, not on actual profit. The filing names it directly. Uncertain tax positions. The line for 280E subtracted 59 points from the rate, about $24 million, and penalties and interest took another 18 points. Strip out the tax, and the operating engine is actually turning over. Gross margin climbed to 56% in the first quarter. Adjusted EBITDA reached $33 million, a 31% margin, up almost 400% from a year earlier, and up 11% from the prior quarter. Operating income turned positive at $9 million, and operating cash flow swung to positive $12 million in the quarter, with $138 million of cash in the bank. The business works. The tax code is the problem. Here is the number almost nobody is modeling. Sitting on Vireo's balance sheet is a reserve for unrecognized tax benefits, the accrued back taxes it is disputing under 280E. In 1 year, it quadrupled to about $134 million, including penalties, roughly a quarter of the company's entire market value. And here is the roll-up twist. More than $50 million of that came from tax liabilities Vireo inherited by acquiring other companies. The buying spree isn't just acquiring revenue. It's also acquiring other operators' unpaid tax problems. And the rescheduling relief is prospective only. It does nothing to erase this. And this is more diversified than the Minnesota label suggests. By the first quarter, Nevada was actually Vireo's largest market at about $28 million, ahead of Missouri at $25 million, and its home state Minnesota at $18 million, with Utah, Maryland, and a wholesale-heavy New York behind them. That footprint was assembled by merging in Deep Roots in Nevada, Proper in Missouri, and Wholesome in Utah, then buying Schwazi, PharmaCann, and the Ease delivery platform. Total assets tripled to over $800 million in a year, and on a pro forma basis, management says Vireo is now the fourth largest cannabis company in the country by revenue. So what happens when the switch flips? Look at the cash. Vireo's current tax was $18 million in the first quarter alone. Annualize that, and the company is handing the IRS on the order of $70 million of cash a year, equal to about 14% of its market value, while barely profitable. If a broad Schedule 3 order removes 280E, most of that drain disappears, and a company with positive operating income flips from a structural loss to genuine profit. Its medical business, including Florida's Fluent, qualifies for relief first. What is it worth as a normal business? On trailing numbers, Vireo looks expensive, around 13 times EV to EBITDA, but that is because the acquisitions were not owned for the full year. Anchor instead to its own run rate. Annualize the latest quarter, and Vireo is doing roughly $130 million of adjusted EBITDA, which puts enterprise value around 6 times. As the deals fully consolidate, comps put EV to EBITDA at about 5.5 times for 2026 and 4 times for 2027, right around the multi-state operator average. Consumer staples and wellness peers trade at 10 to 14 times. That gap is the re-rating. Put that into ranges, and remember this is implied value under stated assumptions, not a price target. Standalone, the market values Vireo around $450 to $500 million, with enterprise value near $785 million. In a base case, where 280E persists, free cash flow stays suppressed, and the value sits about where it is. In a rescheduling case, that $70 million a year of cash tax converts toward free cash flow, and even an 8 times multiple on normalized forward EBITDA implies an enterprise value well above where it trades today. Today's price is, in effect, betting the tax code does not change. 2 things make Vireo more than a tax story. Its home market, Minnesota, launched adult use sales in September 2025 into a structural supply shortage with wholesale flower above $4,000 a pound. Vireo's Green Goods is one of only a handful of operators that could sell on day one, and management intends to be the market leader by being the largest producer in the state. At an EBITDA margin, it pegs north of 60%. An incumbent grower in a price-protected market is a real moat. And while rivals went to creditors, Vireo went shopping, with a CEO who says he despises capital spending that doesn't pay itself back within a year. It is the buyer, not the target. So here's the framework, not a recommendation. What makes this one interesting is that management isn't even betting on rescheduling. The CEO says he builds to perform whether the rules change or not. The bull case, the fastest grower in the sector, real adjusted EBITDA at expanding margins, a Minnesota moat, and the most leverage to rescheduling of any name we cover, because almost its entire tax bill could vanish. The bear case, a $134 million tax overhang, the relief does not erase, some of it inherited, a debt wall in 2028, and relentless dilution. Watch the June and July Drug Enforcement Administration hearing, the Fluent close, and the current income tax line each quarter. That line is where rescheduling shows up first. This entire analysis was built using RoboSystems, an open source platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. You can set up the same tools I just used in about 5 minutes. Head to robosystems.ai to get started. Link in the description.